And then I looked at it and saw that basically liquidity generally front runs PMIs, and Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense. But of course, if you have a big enough industry-specific blow-up, like we saw with FTX, and like you might see with some of these others, that can temporarily override the macro factors, because it doesn't matter if liquidity is good if there's some massive forced selling whale out there. If Bitcoin gets to a point where it's a multi-trillion-dollar asset, and the volatility starts to reduce because it's more widely held, that's when I think that more and more nations will be like, wait a second, maybe we can use this as a reserve asset. Maybe we can use this as a payment system. I think it's just still too small and volatile for it to be on most of the radar in a truly serious way. So historically, Bitcoin has been one of the purest liquidity plays. So when you look at various measures of domestic or global liquidity, generally when liquidity is rising, that's pretty good for Bitcoin. And when liquidity is falling, Bitcoin's usually either going down or sideways. And starting around the beginning of Q4 of last year, some of the liquidity indicators started to bottom and turn back up, at least temporarily. And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then, if not for the whole FTX debacle. And so that kind of delayed the rally, but, with that somewhat resolved, and now, kind of moving forward, I think Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally. And so, basically liquidity indicators look okay for the next couple of months, but overall long term, they're still not in a very good place. I think that no one should trade on that specific thing, but it's more like an observation. And that part of the underlying causation, that, correlation, is that generally that's the market kind of assessing that the Fed's getting close to being done its hiking cycle. And so that's kind of what happened last time, where when the 2-year rolled over the Fed funds, that ended up being the top of the hiking cycle, and that ended up marking the bottom of Bitcoin. And so right now, I think we're seeing shades of that. It doesn't mean that it's the exact bottom. It doesn't mean that the bottom's guaranteed in. But I do think that the part of the downward move in Bitcoin that was specifically from the dollar rally, I think that's kind of behind us. And now I think we probably have a longer grind ahead of us to, kind of start rebuilding from here. But I think when you look in the second half of this year, there's still some liquidity concerns, but it's too early to say, because it partially depends on what humans do, what Jerome Powell does, what different policymakers do. And of course, that's always impossible to predict. There's still big things like that can move the crypto specific industry. But overall, like historically, Bitcoin has been very correlated to macro factors, and specifically liquidity. And I've looked at it over the past couple of years, because a lot of people, they look at the halving cycle. That's obviously got some degree of correlation. But then if you look at, say, Bitcoin and the Purchasing Managers Index, which is one of the leading macro indicators, generally when it's rising, it means the economy is expanding, growth is accelerating. When that's going down, growth is decelerating. If it goes below 50, it's potentially outright contracting. And generally, Bitcoin's rather correlated with PMIs. It usually runs a little bit ahead of PMIs. Like, it usually front runs it a little bit. And then I looked at it and saw that basically liquidity generally front runs PMIs, and Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense. But of course, if you have a big enough industry-specific blow-up, like we saw with FTX, and like you might see with some of these others, that can temporarily override the macro factors, because it doesn't matter if liquidity is good if there's some massive forced selling whale out there. Most of the indicators point that we are like early stage recession or late stage expansion. And so a lot of the leading indicators, like, conference board leading indicators, purchasing managers indices, those things are rolling over. Industrial production's rolling over. Inflation adjusted retail sales are rolling over. And the strong area, as you point out, has been the labor market. Historically, that is a lagging or coincident indicator, meaning that by the time unemployment is rising, you're usually already in a recession. And that's part of the reason why those 2 negative quarters weren't kind of a full recession, is because unemployment was still pretty low and not really worsening yet. Even in the labor market, though, we're starting to see that some of the early indicators there are not looking good. So it's too early to say, because we're not necessarily in a recession yet, although we have kind of pre-recession warning signs, or early recession warning signs. But when you have like a yield curve this inverted, when you have economic activity slowing down, when you have a purchasing managers index sharply rolling over, all that's pointing towards recession. So I think you can only give them a full grade after the fact. I think we do have enough information though to obviously be critical of the Fed. I mean, they were, talking about how they were going to not even thinking about raising rates, that they were going to hold rates low for years, that any inflation would be, not that big of a deal and transitory. Then you had a massive inflationary spike, and then they suddenly shifted course and started changing everything. And you can imagine how if you're actively managing the price of money, if you're actively managing the ledger that everybody uses, sharp changes like that and flip-flopping your outlook and what you're calling for can cause quite a lot of disruptions. I think overall, as you see a deceleration, if it's not a sharp liquidity event, I think assets like gold and Bitcoin, for example, can hold up pretty well in that type of kind of early recessionary environment. It's really when you get that sharp liquidity problem where credit markets freeze, something like that. And that's happened a lot recently, but that's normally not how recessions played out, right? We often think of recessions as these big vertical down crashes, but that's really the past handful of instances. Going back prior to then, usually recessions were these more rolling, slow-moving problems. And so we'll see how this one plays out. I think some of the major liquidity issues already happened. Again, partly going forward will depend on human decisions. But I think this one could be a more rolling and grinding type of recession. But, we'll see. Russia already talked about it, how certain payments could be made in it. I think they view it generally as too small. Right now, Bitcoin's less than like $500 billion. And it's this like volatile, free floating one. And so the way that I noticed the way that academics or economists often approach this is it's like not exactly as they envisioned. They're like, oh, that can't possibly work. And so I think it will probably keep being dismissed for a while until it's too big to ignore, right? So right now, all the major powers are looking for these more like, specific agreements, whereas Bitcoin is more like the people's money, right? It's kind of the people's like global settlement asset. And I think this can be the case for a while. And, if Bitcoin gets to a point where it's a multi-trillion-dollar asset, and the volatility starts to reduce because it's more widely held, that's when I think that more and more nations will be like, wait a second, maybe we can use this as a reserve asset. Maybe we can use this as a payment system. I think it's just still too small and volatile for it to be on most of the radar in a truly serious way. There are a lot of ways to slow it down. I think that the lowest hanging fruit would be to cut it off from the banking system. And so, the way that, say, in the United States, we have the First Amendment, and we have other kind of protections that have been successfully used to, defend the use of encryption, defend the use of code as speech, right? So it's pretty hard to tell people that you cannot run a full node open source software, that you can't, memorize 12 words, that you can't, flip a coin 256 times and generate a private key, right? It's very hard to enforce on that level. But it's really easy to tell banks that you can't send money to crypto exchanges or brokerages, or fiat on ramps into Bitcoin and crypto and things like that. And so that's kind of the big lever that could be pulled by the United States, by Europe, and by some of these other major countries. I mean, back in 2018 and for years since then, India was exploring that, right? They were like, kind of flip-flopping between maybe we should ban all this. And then it's like they kind of realize like you don't actually ban it, you just ban yourself from it, which can maybe work temporarily, but it's not really a good long-term strategy. And so overall, I think that the biggest impediments are just restrictions on privacy, attempts to make it harder to self-custody your asset, as well as kind of the potential giant attack would be to severing from the banking system. But that'd be a pretty major event. The short answer is a lot of it has to do with fiscal decisions. But if we back up a second, if we kind of examine the hypothesis that QE is heavily correlated with wealth concentration, then one thing that we should find is that if you look at the major countries, the more QE they did, the more wealth concentration we'd expect them to have, if this was a strong correlation. In reality, we find either no correlation or actually slight inverse correlation. So for example, Japan did way more QE relative to its economy than the United States did, and yet they have less wealth concentration than we do. Europe has done somewhere in the middle between Japan and us, and they're also somewhere in the middle in terms of wealth concentration. So when you kind of look at that variable alone, you say, okay, clearly there has to be other variables here explaining how wealth concentration erupts that are either overriding this or impacting this in some way. Number one was going back to the 2008 thing, basically bailing out the banks, not the homeowners. That's number one. Number two is by running persistent trade deficits in the United States due to our global reserve currency, due to a number of policies that we do, we basically outsource a lot of labor. Yeah. And then those trade deficits, a lot of those, even though they're not getting funneled back into treasuries anymore, they are getting funneled back into our stock market. So, right. Saudi Arabia is taking their oil money and then they're coming back in and buying assets with it. Firms in China are coming in and buying our single family homes and driving up the prices. 10% of people own like 89% of the stock market. Right. So that's going towards the top 10%. Then we had tax cuts that mostly favored the wealthy. So basically, if you were making the middle class, you got a smaller tax cut. If you were doing pretty well, you got a bigger tax cut. And then in 2020, again, basically, if you were making middle class, you got like a little bit of a bailout. If you were running a small business that didn't need the money at all, and you had to play your cards right, you could get $500,000. You could get $1 million, and it's like getting dozens and dozens and dozens of individual stimulus checks. Right. And so basically, every time you kind of encounter this decision point, instead of funneling money towards the bottom or not funneling money at all, we always tend to funnel money kind of upward, and we disguise that with like small handouts to the middle.